We now come to the last session of the conference, which is on value added tax, or more specifically on the impact of value added tax on Islamic finance. So for this session, may I please invite Mr. Khalid Hamad, who is the Executive Director at CBB and also a member of the Board of Trustees at AAOIFI. Joining Mr. Khalid Hamad on the stage will be two speakers and two commentators. The speakers for the session will be Mr. Stuart Halstead, who is a partner at EY. And Mr. Mahesh, who is a partner at KPMG. The two commentators in the session will be, and may I request both of you to also join us on the stage, Mr. Amir Bhatti, Director Middle East Deloitte, and Mr. Arshad Gadet, Partner BDO.
بسم الله الرحمن الرحيم والصلاة والسلام على أشرف الأنبياء والمرسلين. Today we will have the session regarding the impact of the value-added tax law and regulation on financial institutions, especially Islamic financial institutions. So we can start with Stuart Halstead. So basically he's an EY partner specializing in taxation. So he will give us a presentation for a maximum of 15 minutes. So please, the floor is yours.
Good afternoon, everybody. So just a few words by way of brief introduction. So the conversation today is around about VAT and its impact on Islamic financial services and products. Naturally, it's a very interesting topic for me. I'm a VAT person. I've been doing VAT for a very long time, and I find it a very interesting subject and quite a departure from the way in which VAT normally operates. But ultimately, the session today is to try and give you a bit of an overview of what is likely to be seen here in Bahrain and what is seen around the world, and some of the challenges that are faced by the institutions dealing with these products. It is obviously an interactive session, so we will try and wrap up the presentation aspect relatively quickly and then invite everybody to ask questions and take the discussion further. So I think most people understand VAT. I suppose what they probably don't understand is quite how significant VAT is as a contributor to public revenues around the world. And this chart here sometimes surprises people simply because most people don't quite appreciate how limited the contribution of corporate income tax is to governments around the world as a percentage of total tax revenue versus how much revenue is generated by governments from VAT and customs duties and excise duties. And as you can see there, the yellow line is actually the contribution of corporate income tax. So overall, it contributes around about 9% of revenue, total tax revenue to governments. The blue line is the VAT contribution, and that's approximately 20%. So if you then add the VAT contribution to the customs duties and other specific consumption taxes, you actually end up seeing VAT and those taxes contributing around about 30% of all taxes to governments across the OECD. Now, obviously, that's a very significant contribution. And I think that the story here is to think, VAT as an instrument is being introduced into the GCC, has been adopted by KSA, has been adopted by the UAE, and will shortly be adopted by Bahrain. It is a tool, a fiscal tool, which enables a lot of government spending around the world. The VAT rate of 5%, which is going to be introduced here, is very low, comparatively speaking. The average rate around the OECD is about 19%. So 5% here, 19% in other jurisdictions. It doesn't take very much for governments to generate a lot of money from VAT. So I think that's really the story here, and not to dwell too much further about it. Now, you will all probably be aware of VAT in some way or another. You've probably spent money in another country and ended up paying VAT on things. But ultimately, the VAT value chain is very long, and ultimately it affects all transactions in transactions in goods and in services. So it's fairly agnostic. It doesn't look specifically at who you are or what you're doing. It just simply says, if you are supplying goods and services, I want to tax you. And the way in which the system works, by charging VAT on the supply, on the transaction, and allowing intermediate businesses who are buying and selling those goods and services to recover the VAT that they spend, so the input tax credits and the output tax debits, essentially they net off against one another to the point where at the very final point of consumption, the end consumer pays the total amount of tax, and ultimately they bear the total tax burden. And that's the way VATs are supposed to work. It is supposed to be neutral on the majority of businesses. It is not supposed to change the decisions that you make as businesses, whether to invest or not. And it's also not intended to distort the purchasing decisions of individuals as well. So, broadly speaking, VAT targets final consumption. It is not supposed to target intermediate consumption of goods and services or incorporation of those goods and services into final products. Number two, it is supposed to have a broad base. That means that you're trying to tax as much as you possibly can. If you only tax a few things, naturally people won't buy those things. But if you tax everything, people will continue to buy the things that they've bought for many, many years. So you don't try to distinguish between them. And then finally, it's supposed to be a burden on consumers and not on businesses. However, the fact of the matter is, VAT doesn't always end up targeting final consumption. The way in which VAT systems are designed, and one of the things that we'll talk about shortly is the way in which they're designed for financial services products, actually results in some of the VAT costs that you would want to see land on the final consumer being borne by the institutions between the initial production and sale of those goods and services. So ultimately, it would be nice to see final consumption tax only, but that doesn't always happen. We also see that the broad base sometimes is distorted. We'll see, if you've had a chance to read the Bahraini VAT legislation, you will see that there's lots of zero rates and exemptions that have been provided for in the legislation. Those minimize the tax base. As I said before, it'd be nice to tax everything because you don't distort people's decision making. But if you start to relieve certain elements of the overall transactions in the economy, then people will start to seek out those things which have been relieved from tax. And finally, we were talking about the fact that we would like for the tax to be a burden on consumers and not on businesses. That isn't always the case, and financial institutions are a prime example of where VAT ends up being a cost to business as opposed to being a cost to the final consumer. So here we see, we talk about the legacy of the VAT treatment of financial services in legacy VAT regimes. Because of the challenges of identifying what the value of a financial service is for VAT purposes, in many jurisdictions around the world, what they've done is they simply said, you know what, we're not going to try and value it and we're not going to apply VAT to it. We will treat it as exempt from VAT. We will remove the VAT charge because it's just too complicated. The problem with doing that, and as I said, that the IMF here, this definition here, for technical reasons, financial services are commonly VAT exempt. That is a sort of a rule which I would associate with legacy VAT regimes. And essentially what has happened is those rules have become bigger and bigger and bigger, and the breadth of the exemption has just got larger and larger. If you look at some of the very traditional financial centres with VAT regimes like the UK, Germany, France, their exemption for financial services is enormous. It applies not just to the actual primary lender, for example, but actually applies also to the agents who are organising the lending as well. It applies to insurance products. It applies across a range of products. And ultimately, it is not actually particularly effective from a VAT point of, from an economic point of view. It is highly distortive. It builds in a lot of VAT costs into the supply chain. And ultimately, legislators are trying to move away from that model. Now, notwithstanding the fact that the financial services under legacy models typically has a VAT exemption, for Islamic finance, that exemption poses some specific challenges. The fact of the matter is, traditional financial services typically aren't asset-backed. And VAT is a very simplistic tax. People talk to me about VAT and they think it's really complicated. It isn't very complicated at all. VAT looks at what are you doing. So if you're selling something, if you're giving something, if you're charging the amount of money for something, it presumes that there is a supply for VAT purposes. It wants you to value that supply, it wants you to raise a VAT invoice, and it wants you to account for the tax on that transaction. Now, the fact of the matter is, under traditional legacy VAT regimes, where you have traditional lending models, for example, there isn't an asset underlying the transaction itself. I'm merely lending you money and charging you interest for the privilege. Under Islamic financial products, the majority are asset-backed. And as a result of that, we end up with lots of transactions where we're buying and selling goods. And because we have these transactions where we end up buying and selling goods, the VAT rules around the world, frankly, they look at them and they say, well, you're making a supply of the goods, and therefore you should charge VAT, you should raise invoices, and so on and so forth. And as a consequence of that, you end up with a distortion being created between legacy products and Islamic and Sharia compliant banking products. You create a distortion in the market, which ultimately is not a particularly helpful outcome. Naturally, as I said before, you want to keep the base nice and broad. You don't want to suddenly incentivize people to choose a traditional product over a Sharia compliant product and vice versa. So here's an example, and my colleagues on the panel, I think, will at this point probably want to talk a bit more about products. But if you take a traditional asset finance arrangement, as you can see here, we have a vendor who sells or provides the goods to the ultimate consumer. They charge VAT, they account for the VAT to the tax authority, and that's sort of the end of it, because ultimately the intermediary, the banking institution, lends at interest, and ultimately we can see the total cost to the end consumer is dictated there. So in this particular instance, 1,155. Take the equivalent product from an Islamic and Sharia compliant product perspective. We end up, as you can see, with far larger number of transactions taking place for that purposes. Ultimately, we have a buy and sell transaction between the vendor and the intermediary, the institution, and the institution themselves is treated then as selling that product back to the final consumer. We have lots of input tax credits, output tax liabilities requiring to be accounted for, and ultimately, if unrelieved, the cost of that product, comparatively speaking, is actually higher than the legacy legacy product. So the cost would be higher if unrelieved. As a consequence, what we have is this notion of equivalence. So what the tax authorities in many jurisdictions do is, rather than writing legislation, one of the things we're going to talk about is, should we legislate for this? Rather than legislating specifically and purposely for these types of transactions, they merely say, we would want you to try and achieve the same outcome for VAT purposes as you would do under traditional products or Sharia compliant products. You do not differentiate. You do what is necessary to remove the additional cost. disregard those transactions which you need to disregard, and ultimately you want to net out at the same result. Now that all sounds fantastic in principle, but the reality is that means you require to go through every single transaction and think about it and work out what it is you need to remove in order to come out with the same answer. And why is this important? Well, it's really important to do it now, particularly when VAT is coming. It's important to do it now because you need to work out how to price your product. You need to work out where it is you're going to end up with sticking VAT costs. You need to think about how it is you're going to remove those things. Now, you know, we'll talk about the legislative side of things in a second, but Saudi Arabia didn't introduce any guidelines to the financial services community until July last year. So they implemented VAT on the 1st of January, and the final version of the financial services guidelines came out in July. Now, in terms of certainty, that's actually very hard for institutions to get things right in the intervening period. And even the guidelines now, as they are currently standing, contain a lot of challenges for organizations. We still see problems around invoicing. We still see problems around how extensive is this disregard and what the implications of that disregard should be. So, in short, it is complicated, and VAT doesn't sit very well with modern-day Sharia-compliant products. As I said, that was one example. We have another example here, and frankly, we probably have a number of examples where we can go through the same scenarios and show you that ultimately, if you didn't do anything about it, the Sharia-compliant product would be more expensive than their counterpart. So, very briefly then, what is it currently that's in the Bahrain VAT law that is particularly of interest to the financial services sector? Currently, so about 2 weeks ago, the law was released. We saw that there's going to be a 1 January 2019 implementation date. We saw a provision for VAT rates ranging from 0%, so that's the zero rate that I was talking about, 0%, and the standard rate of 5%, and we also see these exemptions introduced. So there's nothing particularly revolutionary about this law here because we've seen exactly the same elsewhere in the UAE and Saudi Arabia, and indeed in other jurisdictions around the world. We have a new tax authority, and the financial services wording contained in the legislation, it says that the supply of financial services will be taxed to the extent that the fee is identifiable and charged in an explicit manner. So if I can identify my fee, I must charge VAT on that fee. So when we looked at this legislation and we said, well, what's good about it, what's not so great about it, and what's going to be really hard, the funny thing is, we did the same analysis when we looked at the implementation of VAT in Saudi Arabia, and frankly, everything is kind of the same. The same challenges that we saw in Saudi Arabia exist here in this legislation. Nothing particularly special has been written to improve the lives of financial institutions, and specifically nothing has been written to improve the lives of Sharia-compliant financial products. And I think that we need to be aware of that. This is a real threat to businesses, and I think one of the interesting aspects of it, and to some extent some of the most relevant aspects have been highlighted here, but what's particularly interesting here in Bahrain is the penalty regime for getting things wrong. In Bahrain, the legislators have essentially said that if you do not meet your obligations, in many instances, if you fail to meet your obligations, well, up to 60 days after that obligation should have been met, we will treat that as a civil penalty matter. We will fine you, and that will be the end of it. However, if you are 61 days late, we will treat that as a criminal matter, potentially, and we may actually put you into prison as a consequence. It is an incredibly draconian set of legislation with respect to penalties, and we have major concerns around the ability of businesses to get ready in time to comply, bearing in mind these penalties that are on the horizon. One thing I would also say is, if anybody thinks about the economics of VAT, broadly speaking, it was estimated that Bahrain would generate around about 2.2% of GDP equivalent by way of revenue from VAT. That was initially modeled around about 5 years ago. I think that the reality is going to be somewhat lower. I don't think there's going to be that much contribution by way of VAT in Bahrain. Just the nature of the zero rates and exemptions that have been introduced, I just don't think we're going to see it. So what are the biggest challenges to implementing VAT? Well, I would actually probably look at it a slightly different way. I genuinely believe that VAT is a massive opportunity for organizations to think about how they do business and how to improve what they do. VAT is fundamentally rules-based. And to some extent, that makes it really quite straightforward. It looks at the who, the what, the where, the why, the how much type questions. And it does that every single time. So if you know what you're selling, to who you're selling it, where they are established, what the value of that supply is, all of those things can create a rule book by which you can start to define your processes and start to automate the process of selling products, of reporting those products, of raising VAT invoices, and so on and so forth. Automation, and I think there was the title of the conference, the role of standardization for the future of Islamic finance. VAT and standardization actually work really, really well in many instances. It's not perfect, but it works really well. I actually went online. There's a tool. I went on the BBC website, and it looked at what there was a survey done, and it essentially said, do you think your job is going to be automated in the future? Will your job become redundant in due course? So I filled in the box. What do you work in? Finance and accounting. What do you do specifically? What level are you? Managerial, and so on and so forth. It essentially came out with the result that 80% of what I do will be automated in due course, which is slightly worrying, naturally. However, I think the point is that it's particularly important to think about VAT as an opportunity to automate, to build technology that helps you simplify the accounting process and actually improves the way in which you do business overall. So, as I said, it's an opportunity to automate, it's an opportunity to innovate and to improve the way in which you understand your transactions with your customers. It's from an implementation point of view, not only do you need to spend time thinking about who you sell things to and who you buy things from and where those people are established, you also need to think about, okay, bearing those rules in mind, what is the resulting tax treatment I'm going to apply to these particular transactions? And as I said, most of those things can be automated to some extent. The ability to report accurately, the ability to report on time is really critical as well, and oftentimes that requires people to spend time now thinking about what is it that I'm going to have to tell the tax authority every single month so that they can build the reporting that they need in advance of that demand. And the speed by which you are able to respond to the tax authority also becomes really critical. We've seen it in Saudi Arabia, whereby you have 20 days to respond to a query raised by the tax authority, and they could ask you for anything. The powers of demand in terms of the information are enormous. So you have to provide that information within 20 days. So if you're not able to produce information consistently, on time, and quickly, that becomes a major problem for the organization in due course. And ultimately, we need to think about the organization and the people within the organization as well. You need to spend time helping people understand what the VAT means for them, why it's important to get it right, how to ensure that they're not offending any legislation anywhere, and making sure that there's adequate governance around the VAT process. There's got to be an audit trail. You can't just simply submit a VAT return and for everybody to absolve responsibility for the quality of the information that's contained within it. So just very briefly then, and just to wrap up, we had a quick look at this point around equivalence. So as I said to you, VAT doesn't work very well in the normal sense when it comes to Sharia-compliant products. So the majority of jurisdictions around the world have built what we call an equivalence rule. So in Saudi Arabia, as you can see, they have an equivalence rule. They basically say, if you have a product which simulates the intention of another comparable product, a traditional product, then we will find a way to relieve the underlying asset-based transactions from VAT so that you end up with the same result. The wording is almost identical in the UAE. In Bahrain, they have the primary law has come out, and that is what the primary law says, I would be very surprised if the regulations didn't say almost exactly the same as what we've seen in Saudi Arabia and in the UAE as well. Does it help that it says those things? Well, frankly, not, because at the end of the day, you still need to go through all of the transactions and understand them and make sure that you are doing the right thing at the right time. So, in summary, VAT, there's a classic phrase that's used about VAT. They call it the fiscal theme park, because at the end of the day, a lot of what you thought you knew about your business, you tend to just have to put it aside and start thinking about things in a very different way, very transactional. Who am I buying from? Who am I selling to? Where are they? What is it that I'm selling? And so on and so forth. And ultimately, as a consequence of that, you have to actually start spending a lot of time getting ready for VAT and making sure you're doing the right things at the right time to ensure day one readiness. And ultimately, we've seen in the region that the implementation has not been particularly well received by the financial services sector. There have been problems. I think there's an opportunity to address those up front, to engage as a community with each other and also with the government before we see the final regulations coming out. But ultimately, what's most important is to start thinking about the impacts now and preparing for the inevitable change.
From his point of view on VAT.
Thanks, Khalid. I think thank you, Stuart, for a very good introduction on VAT and its impact on Islamic finance sector. So what I'll try and do is I'll probably talk about implementation challenges from a practitioner standpoint, and probably take the lead from where Stuart gave us a good background on. So I think with any tax, what it brings in is tax enforces discipline, discipline in documentation and discipline in transactional reporting. So I think that is one general theme everybody needs to be aware of and be prepared for. This discipline of recording transactions through the system, the granularity of the transaction, the need for segmentation, because VAT is going to challenge the way businesses were being done at that level of granularity. So I think one big general message, which is more agnostic across sectors, is transactional discipline, documentation discipline, and the IT infrastructure is a must for you to be able to comply and understand what VAT means for the sector. So in particular, when we now take that to the Islamic finance sector, so I think two themes have been established. One is the concept of equivalence. I think in general, the expectation is that Islamic finance products would have similar treatment of equivalence to its conventional counterparts. The financing income, whether implicit or explicit, is something that would be exempt. But the fee-based income or the arrangement fees income, which is service-oriented, is what would be the subject matter of VAT, and that would be deemed as something that is being consumed by the customers and provided by the Islamic financial institution. So now if you take this general theme down to individual Islamic products, what does that really mean? Do we need to go more granular than where we are as Islamic financial institutions today? And how will our systems actually handle it? I'll probably try and spend a bit more time looking at that. So I'll touch on the general products. So if you look at every product, we are going to have two components. We are going to have something that is going to be exempt because it's deemed a finance income or income from provision of financial contracts. And you will have a part which would be subject to standard rate, which is the the fee type element. So if you look at a Muraba contract, there will be an initial purchase or sale of goods. There would be charges related to the asset, which would be subject to VAT, and there would be the administration fees that is going to be subject to VAT. The element that would be exempt would most likely be the profit. Now, I think the question to look back and ask is, when Islamic financial institution is actually recording this transaction, are we actually going to that level of granularity to separate, segregate an account? If you take a Muraba financing, we are currently in most core banking systems are not necessarily tracking the purchase leg and the sale leg. The net financing leg is what is recognized, although the underlying documentation from a Sharia standpoint has the supporting, you have an invoice. If you take an interbank Muraba transaction, you have an invoice through the metal exchange where you have a purchase and sale. But this gross level transaction is not something that is actually considered through the system. So I think one thing to look back is, while this might still be exempt, but the need to track and recognize this through the system so that it can be subject to a VAT inspection becomes all the more critical. This statement is easier said than done because the volumes of transactions, if we just take the interbank market between various financial institutions, you're talking about millions of contracts that are rolled over on a weekly or daily basis. So you're talking of $1 trillion worth of transactions that could possibly happen within the Islamic finance sector just on these arrangements. I think these are where clearer rules need to be established on what is the expectation from the sector in terms of recognizing transactions, what is the level of granularity of recording these transactions, and what is the required documentation that needs to be maintained. This is one example. If you look at Ijara as a product, again, for anything with Islamic finance, it is asset-based, and more often than not, the underlying asset is real estate. So I think for Islamic finance to have more clarity on how to deal with VAT, I think the rules on real estate have to be much more clearer. I think from what we gather, the current regulations is not as explicit or clear on what they are going to do on real estate. And we are aware that the rules in Saudi are different to that of what was adopted in the UAE. So it's going to be interesting to look at what rules Bahrain would eventually adopt and how that would be transposed to the underlying VAT assessment on Islamic finance contracts. So Ijara is a common example where the underlying is usually real estate. So what is the position of leasing? What would be the VAT position at the time of acquisition? What would be the VAT position at the time of transfer of assets? These are things that would be critical to understand from a product profile standpoint. Yes, there will be an embedded profit element which intuitively should be exempt, but how do you actually split your installments between the element of profit and the element of recovery of principal? Now here is where again accounting could possibly pose a challenge. I think the AAOIFI accounting standards here are slightly different to how we would recognize similar transactions under IFRS. So again, clarity on this aspect is important so that the VAT treatment can be clearly identified and separately recognized as an obligation within the financial statement. Similarly, if you look at other products, Musharaka, Mudaraba, if it's a financing contract, I think again the concept is clearer. The profit element would be exempt and everything else should ideally be used at standard rate. But again, a look through of the structure is important. Both Musharaka and Mudaraba could sometimes have composition of an equity contract and could sometimes have a composition of a debt type or a financing equivalent contract. Now, dividend income or equity-based income is typically out of scope. It is not exempt. Whereas financing income is something that would be exempt but not deemed out of scope. Under the VAT regime, I think these terms are very important because they determine the extent of recovery you could make around input taxes. So again, for Islamic financial institutions, tracking the type of underlying contract, whether it would be deemed an equity instrument or it would be deemed a financing instrument, becomes equally important because your ability to recover input tax could be substantially different. So I think if you now look at a typical spread of an Islamic financial institution, you would have things which will fall under three categories. Things that would be under standard rate, which is 5%. There are some things that are zero rated as well, but we look at what is standard rated. Things that are exempt and things that are out of scope. Now, categorizing your VAT transactions into these three segments is important because this, like I said earlier, this will drive the extent of input tax that you can recover. Now, a typical trading business, VAT is not an incremental cost because what I pay on my inputs, I would recover through sale of my outputs. So it's eventual cost that would be passed on to the consumer. But in the banking business or Islamic finance as a business model, I think the recovery of input taxes is pretty low. I think there's some stats or experience that will show that it's as low as probably 20%. So what it means is your cost base is definitely going to go up because your income generating products are not VATable or they are exempt. So you would not have the ability to recover the costs which you have incurred on services and purchases which you would normally pay for your operations. So categorization in these three categories would allow you to plan on what is the element of recovery you're going to have and what is the increase in the cost base. So if you quickly run through the list, fees and commission income, which are explicit service-based arrangements, would be subject to a standard rate. The principal element of the underlying commodity when there is an acquisition in a Muraba or Ijara contract would be typically subject to a VAT. Musawama structures, which is where, for example, if you're running an auto mall, when you finance a customer, there are two elements of your profit. One is the margin on sale of the product, and the second would be the profit element through the installment. So again, Musawama as a product should be attracting VAT, and any sale of real estate in the structure would again be subject to VAT depending on what final rules come through. What are exempt is the profit element on the financing arrangement. Now here again, both the implicit and explicit ones would need to be considered. Income from investment in Sukuk. Sukuk, while from a pure Sharia standpoint is deemed an equity instrument, but from a distribution standpoint sometimes operates similar to a yielding instrument. So here again, there's a classic example of a standard Sukuk would probably be deemed exempt. But if it's a 81 Sukuk or a perpetual Sukuk, which from an accounting standpoint is classified as equity, I think there are some questions which probably need clarification on whether this Sukuk would be an exempt income or would it be an out of scope income. So I think these are things that probably need a bit more clarification when we look at specific Islamic underlying structures. Wakala income, the underlying financing arrangement or the excess profit which you earn, again is currently classified under the exempt category. Any realized currency spreads is being deemed as the exempt category. What is out of scope is any gain on sale of equity instruments or dividend income. Bank charges which are deemed punitive. So if you're charging penalties or if you're subject to penalties, anything that is punitive in nature is again out of scope of VAT in general. Now, this is the impact on the income side of your business. When you look at the expense side of the business, you would probably see the list of typical expenses that we can segregate between standard, exempt, zero rated or out of scope. So most of the items would typically be in scope, which would mean that the expenses you incur to run your business would have a VAT element. But there are certain type of expenses which should not be considered as eligible for deductions. For example, if you spend on gift or entertainment, there are certain thresholds based on which it may not be allowed as part of the input base. The interesting thing to note is board remuneration, directors' fees, sitting fees, all of this would also be subject to VAT depending on the threshold. Now again, these are things, you're not dealing with corporates, you're not dealing with typical service providers, you're dealing with your individual board members. These are areas where you need to be mindful on how you're going to deal with compliance. You need to have stronger contractual arrangements. Are you going to expect your board member to raise an invoice for every board meeting? How do you actually take care of your documentation? I think these are areas where you need to be mindful about. So I just had an example of an Ijara transaction because the real estate rules as yet are not very clear in Bahrain. So I think it's important because you will have a VAT exposure at the time of acquisition, and you might have a possible VAT exposure at the time of transfer as well, depending on the underlying asset. You know, whether there is going to be a differential treatment between residential and commercial. There are again different rules both in UAE and KSA. I think this is something that needs to be closely looked out for. I'll probably spend some time on the concept of input tax recovery. Now, input tax recovery, the first model, like we discussed earlier, is everything I pay on my inputs, I can collect through my output. This assumes that my output also 100% of my output has a standard rate. You then have the mixed model in between where not 100% of my output is subject to standard rate. Some of them are exempt and some of them are out of scope. Now, what it means in simple terms is if I pay 100% VAT on my cost base, if I'm not able to charge that to my customers, can I actually recover or transfer all of that as a refund, or can I recover it from the VAT tax authorities? Now here again, you have different rules in both the regimes. I think in Saudi, it is a proportion of the revenue that is in scope. So whatever is zero rated and at standard rate, plus what is exempt will be part of your denominator, and on what you are paying VAT will be part of your numerator. So you'll only be able to recover that proportion of your VAT on your expenses or the cost base as part of your recovery from the tax authority. Whereas in UAE, this is on the amount of the tax as opposed to the amount of the revenue that is in and out of scope. Now, like I said earlier, in the financial services sector, very few part of the bulk of your income will be finance income. So a substantial portion of your income is not going to recover the VAT you have spent on your costs. So what becomes important is what you deem as exempt and what you deem as out of scope, because that is now going to drive what extent of VAT you will be able to recover. Why this is important is this is going to increase the cost for banks. This is going to increase your cost of doing business. This is going to impact your metrics like cost to income ratios. So this is where your ability to track the nature of income, the split between what is exempt, what is in scope, and what is standard rate will drive what you will be able to recover on your cost base. So I think there needs to be clarity in the existing rules in Bahrain on how this will be treated, because we have differing models both in KSA and UAE, and the amount of recovery could also be substantially different. Now, if you look at challenges, I think Stuart spoke about systems and the need for documentation, but I'll probably touch upon some of the other practical aspects. I think while people are preparing for systems, while people are getting themselves prepared, the rules are still unclear. I think there's an expectation within the next week or 15 days you'll probably receive a bit more granular rules. But again, in the Islamic financial sector, we are not necessarily sure whether there'll be separate or specific guidance. So you will have little time to prepare and cover for all these exigencies within your system implementation and in your backend infrastructure. I think we were having a side discussion before the session. I think what is very important is the Islamic finance sector gets together, brings out all of these issues maybe to a common forum, so that even the tax authorities have a better way to possibly guide you on what will work, what will not work. If that does not happen, you will expect to see practical challenges, or you will see inconsistency in implementation. And with the severe penalty regime that could be possibly imposed, I think you'll be taking more risk by not thinking this through carefully. Pro rata recovery base is obviously a huge risk that drives how much of your input cost you could recover. So this is something that needs to be carefully looked at. Transitional provisions, I call it the VAT Y2K. 1st Jan, what do you do with existing contracts? There is guidance on how you deal with government contracts. I think, for example, they have said that all your existing contracts, as long as they have a continuity period of another 5 years, they would not be subject to VAT if you're doing contracts with the government. But it is not very clear how you're going to deal with your existing contracts with the private sector. Is there an arbitrage opportunity? Is there a loss opportunity? I think the transition rules are not clear. We are very close to the year end. You would be in 1st Jan. If these things are not thought through, you either miss an opportunity or you possibly increase your tax base. Systems, like we spoke about, the granularity of you recording data and tracking is very important, because you only have 15 days to raise your invoices and 30 days to submit your returns. The discipline around that has to substantially change. I think our focus was all around regulatory in the first 10 days or 15 days. This will now also include a lot of being prepared for VAT. There are a lot of hybrid instruments in the market. I think how do you treat those? We spoke about Sukuk, AT1 Sukuk. It doesn't qualify as a debt, it qualifies as equity. How do you really treat the returns on those instruments? Is it exempt? Is it out of scope? We talk about regulation, we talk about systems. I'll probably wrap up by saying don't forget the impact on your customers. I think as a bank, as an Islamic financial institution, this is a huge opportunity because VAT also creates a working capital deficit. Your customers are going to need more cash. The cycle of payments are likely to change. So while it presents an opportunity, when you do the risk review for your customers, is also going to create much more challenges in their ability to pay. So it also increases the risk of customers who probably are working on weaker cash flow positions because they have a government obligation to pay which precedes that of the banking obligation. Uh, Also, in terms of structuring products, I think how you deal with your auto loan or auto financing product or Ijara product, are you willing to absorb the VAT cost upfront and take it over installments? Or are you going to ask your customer to pay it upfront? Would also impact the ability to compete with the market and sell your products on the line. So while there's a lot to focus on regulation, I'll close up by saying there is an opportunity on increasing the funding base. At the same time, there is also a risk that your customers might struggle to cope up with their repayment obligations. Thank you.
From Lloyd, you can have a comment.
Yeah, thank you. So I suppose, I mean, what the key theme that's coming out of all of this is that although VAT is at a very low rate of 5%, the management of VAT is a big issue, especially within the Islamic finance sector or within the banking sector itself as well. Because you've got not just one rate to manage, but you've got four effectively, the 0%, 5%, the exemptions, and the outside the scope. And how, as an institution, do you manage that VAT? And those challenges remain because products that have been developed for a certain period of time. That's changing now because introduction of VAT now means that you've got different challenges that you need to look at. Your pricing structures as well, are those going to change? And how are they going to change? Do you have a ceiling on which that you can charge up to the maximum in terms of pricing? And then as an organization, do you have to swallow the VAT cost? So all of that becomes very, very challenging. And what, as Stuart mentioned earlier, VAT is just not a finance change. It's actually a transformation change because it impacts everyone or all the stakeholders within your organization. And if you look at it from an Islamic finance perspective, I think more so because you've got different aspects that are involved in terms of leasing, buying, commodities, investments that are taking place as well. You've got counterparties, not just in the region, but outside the region as well. So you've got to continuously kind of make sure that you're managing this. But I think more importantly, this is also an opportunity for you as a group to understand some of the key kind of issues that you may be facing and kind of working through this together. Because the worst thing that can happen is that everyone does approach VAT in a very different manner, and if that happens, then competitively, some institutions will be at a disadvantage than others as well. But a common approach would be very, very helpful from that perspective.
Short from video.
Thank you very much. Quite a lot of things have been said. I think I'm just going to put a couple of more things to the pot for you to ponder upon. It's a double whammy for Islamic finance. Not just you have to deal with the equivalency with the conventional bank in terms of how you are going to modify and appropriately define to the tax authorities that you are equivalently implicit and explicit fees are in line with the conventional bank. That's one aspect of it. But the other aspect, the mix of the exempt and rated mechanism, which will have the impact on your ability to recover input tax. There will be some structural changes you might want to think about. For example, if you're already doing outsourcing of a sizable portfolio of your own internal employees, for example, for any area of your production in the bank, you may want to think about sort of bringing in-house because that will also have an implication on how your tax overall will be impacted. So tax planning is important. What we've seen in number of cases in clients which are, be it banking or non-banking, they are not thinking of tax planning. They're thinking it's a plain vanilla tax regime. It's going to be very straightforward. You'll be surprised. The devil is in the detail, and it will have an impact on the way you manage and run your business. The other point I want to highlight is for you, in particular in Islamic finance institutions, is going to be very important is to understand how customers are engaged in that overall situation, because they at the foresight they will just think at the outset that conventional banks are much more price competitive, given that the disadvantage they might perceive you would have as Islamic finance institutions. So you have to do some bit of education, uh, but for that you need to be educated yourself to know what the differences are and how you will mitigate those issues, to be able to go and tell your customers that that's not the difference and the competitive disadvantages doesn't exist. Um, the regulator can play a big role, definitely, in terms of defining and working together with yourselves and perhaps with the Association of Bankers to go out and work with the Ministry of Finance to find out the common grounds for you to be able to highlight your issues in advance, as they have done in past for other areas, and being innovative in this all the times for anything which comes down to Bahrain from a regulatory standpoint. So these are the sort of matters which I think there would be something prominent and needs to be dealt with by the industry on top of what's been said by Mahesh and others. Thank you.
Thank you, Shah. Thank you. Basically, what happened now is that the VAT law has been issued, and there are clauses in the VAT which are relevant to our session. I think the exemptions and the certain probably aspect which are certain product that would require zero in VAT rate. But the financial services general is being exempted, with the exception of fees, of determined fees and commissions or even discounts. And according to what we know now, that the Ministry of Finance, Ministry of Finance is working on finalizing the executive regulation to basically determine all of the issues that needs to be addressed. And we are already, have written to the Ministry of Finance, highlighting that there are, that the Islamic financial services require certain or special treatment in order for us to assist this industry to grow and without an impact. And the other thing that we know also is that Bahrain Association of Banks have already formed a committee to review with the other stakeholders, review whatever has been consulted upon, so that then also they can address those issues. So with that, I would like now to open the floor if there are any questions that anybody has in his mind or her mind. Just be aware that all of you, will be subject to VAT. So probably this is your chance to ask a question. And as a matter of fact, also in the law it talks about the sale of land and building, and they are also exempt. I think they are exempted as well. Yeah. Yeah, and the executive regulation will determine the details on this as well. So, those of you, Abis, we have one question.
Voluntary in nature, but then if the fee is just taken, so what is your view on that? If there is a non-profit organization, what could be basis and your experience in also in UAE and also in Saudi Arabia?
Talk about what has you can answer this question from Saudi or UAE perspective.
It's a good question. I wish I could give you a perfect answer. The fact of the matter is, as I said, VAT is actually quite a simplistic formula, and it simply says, well, if you are receiving money, it presumes that you are doing something for that money, and therefore, the very basic analysis would be, notwithstanding the nature of your organisation, the fact is that if you receive this money, you are making a supply for VAT purposes. Now, in the UAE, certain exemptions, or rather certain provisions, have been allowed for whereby charitable organisations, for example, which appear on a list, have been removed from the VAT now, and they've accepted that when they are in receipt of funds, those organisations are not to be treated as being in business and not making supplies, and therefore not subject to the VAT regulations as they stand. But those are very limited exceptions. And I would say that the broad intention of most policymakers these days is to try and limit those instances and minimize them as much as possible, and to keep the tax as broad as possible, and again, to stop people from picking and choosing from what they pay VAT on and what they don't.
I saw in your slides, so suppose that profit when a customer makes a profit on a financial instrument and through the bank transfer this money to him. I thought this will not be subject to VAT, right? Please.
It looks like there are fees which are subject to VAT, but financing will not be subject to VAT. So the seller can usually manipulate. Okay, we have no fees, but pay just the financing. So in that case, the government tax revenue will be less. So instead of going that way, government can adjust this. Okay, no matter what you do, you pay VAT is adjusted with the price. The government will know that this much revenue we will get, no matter the seller will manipulate or not. So have you thought about adding VAT in the price, which will be easy to administer, easy to collect, and the seller knows exactly how much they have to pay. And also, seller will not be able to shift the burden of the tax, incidence of tax 100% to the customers. They will also absorb some of the incidence.
I'm not sure if I followed exactly where you're going with that, but I think broadly speaking, and again, not to dwell too much, VAT, and going back to the incidence of tax, the plan is that the final consumer should be the person that bears the full cost of the tax. So any welfare loss should be suffered by the final consumer, and ultimately any intermediate party to a transaction should not suffer the cost of the VAT. That would be in a perfect world. The fact of the matter is that in the context of financial institutions and the nature of what a lot of financial intermediaries do, it's actually very difficult to value, for VAT purposes, the services that they provide. And as a result of that, we essentially ended up with this treatment historically where basically we've said, it's too complicated, I'm going to exempt you from VAT. And the consequence of exemption is you don't charge your customer VAT, but equally you don't get to recover VAT that you incurred on your costs. So naturally, the VAT becomes a cost to the business itself. And so governments then try and relieve those costs in other ways. New Zealand has got its own approach to relieving those costs. Singapore has adopted a special VAT recovery regime for the financial services sector to simplify and enhance the VAT recoveries that they benefit from. But at the end of the day, there will be an element of transference of the tax cost from consumers to the intermediaries in the context of financial services institutions, and it's just an unfortunate consequence of the design of VAT. It's imperfect.
My name is Ali Al-Hashmi from Dubai. I'm a lawyer. Talking about tax and financial institutions, and in particular the Islamic banking transactions, it appears to be there would be a disadvantage for the Islamic transactions compared to the conventional banking. If financial institutions are not taxed in their transactions, but the transaction in the Islamic banking are taxed. For example, in the murabaha, when you do the sale, there will be a VAT of 5%, and when you do the purchase on the other side, there might be as well, a series of tax that comes. That disadvantages in the, not in favor certainly of the Islamic banking. How would the banks and financial institutions deal with tax in this context, especially that they have to be competitive to the conventional banking? Is there a solution for this?
So we touched on it, and it's a pretty deep subject. We touched on this notion of equivalence. So what the legislation actually tries to do is there's some words already in the Bahrain law, for example, and already in the UAE and Saudi laws, which say, provided you have two products and they are trying to achieve the same thing, and they simulate the outcome of one another, but they just achieve it in different ways, the legislation basically says, we will find a way to relieve the additional VAT costs that one of those products, the Sharia compliant product, might suffer if we didn't take action. But the thing is, the legislation doesn't specifically say what it's going to do. It merely gives the authority to the taxing body to find a way of relieving the transaction. And the problem for that is, as I was saying, in Saudi, the guidelines to help financial institutions understand what they needed to do didn't really appear in their final form until quite late on in the year. And I would go as far as to say there's no one really has properly legislated for Sharia compliant products apart from the South Africans. South Africa is really the only example that I know of who really effectively legislated for it. The rest of the world has sort of left it to the institutions and the tax body to work out what to do. And as a consequence, we have problems. So in Saudi Arabia, right now, and the UK is exactly another great example, we are still finding problems with respect to invoicing. So, for example, Murabaha, take the transaction where effectively you have a vendor selling a product, selling an asset to the intermediary, and the intermediary, in theory, is then selling it to the final consumer. You have an invoice trail there, but ultimately it's between the vendor, the intermediary, and the final consumer. But actually, strictly speaking, the right to input tax recovery can't be created for the final consumer until such time as they see an invoice. And oftentimes the invoice from the intermediary to the final consumer isn't raised, isn't created, because to do so would offend certain principles in Sharia law, for example. So as a consequence, we now have a situation where even though the law is trying to relieve the transaction from the tax, the practical implications of that, because they haven't been fully understood, is still giving rise to a problem at the end. So, it's a big subject. Everybody's trying to relieve these transactions, but it's the practical way of doing that that's become problematic for a lot of organizations and governments.
All right, so thank you. I have two questions. Number one, what's the speaker idea about taxation itself? There are a lot of Islamic scholars not accepted taxation
itself to be implemented in Muslim societies. And it is better to accept and to implement the CA model. This number one. Number two, what is that be implemented in different countries with the different policies and regulation according to taxation? Thank you.
I think that's a very nature of the Islamic product. I think that point as being not being scholars, I think we can't comment on that being that the tax should be applied to Islamic finance institution as a whole or not. And the second point, I think I didn't get the point. I think unless somebody else heard that. What was the second point? Can you just repeat that? Standardization. I think that that's the typical issue. I think all the standard setting bodies, they're trying to sort of work sort of in isolation and in together with each other to try to find a standardization, but the products itself are difficult. See, different financial institutions, not just in this country and in different countries, are adopting different products, and then different products have got different sort of associations with the conventional products. So it becomes very difficult for setting up a standard set of rules for how to bring this at the equivalence level with the others. So some have actually taken a transactional level route, and some have taken at the granular route, sort of a high level route, to compensate the non-equivalency part. But I think that's why I said there's a double whammy here. You need to have two issues to deal with. One, to deal with the institution within with the conventional bank, how you can be equal to that, and secondly, internally also, how the exempt and the rated business impacts your input claim recoverability. So I think the standardization is the idea for everybody, but then you always see, even within GCC, you might not get to the 100% standardization of how they treat conventional versus Islamic finance. That's my take on it.
I think just to make one point here as well, what we found out when dealing with a lot of Islamic banks as well was, the scholar within the bank had a different perception product was, the finance team had a different idea, and the marketing team had a different view. And I think one of the key things in terms of VAT is, and I'm talking about standardization, you get all the stakeholders together to understand exactly what that product is that you're selling. So you have the fair treatment from a VAT perspective. Because otherwise, if you leave it to the finance team to deal with it, their understanding is different from the scholar who's worked with developing that product. So there is an element of standardization that takes place inherently within the organization themselves when they're looking at VAT implementation, because they've got to understand what is it exactly are they actually offering to the market, and is that understanding correct across the board among all the stakeholders who are involved in implementation.